All right, thank you everyone for joining us, and good afternoon. My name is Stephanie Fries, and I'm Anderson ZurMuehlen's Quality Control Director, and I would like to make a couple announcements and introduce our presenters. First of all, you don't have to be on video unless you choose to be on video. Jim will be, and we'll have his PowerPoint presentation up on the screen for your viewing pleasure. So I'd like to introduce the members of the team that work very hard to stay abreast of all the guidance and the rules and regulations governing the PPP loan program. Two of the members will be presenting today, and the other two are working behind the scenes that will try to help answer questions that you submit throughout the presentation, or even if they come in after the presentation. Jim Woy is a shareholder from our Butte office, and he will be our main presenter today. Jim has over 40 years of experience advising and consulting with small and large businesses and their owners. Megan Connors is a senior manager from our Great Falls office, and she will be going through the questions that you submit throughout the presentation and using the chat button, which is at the bottom of your screen. At the end of Jim's presentation, Megan will read those questions and provide answers. If any question is submitted that we weren't able to answer, either need to do some further research or just lack of time, we will get back to you. We will reach out to you and get those answers answered. And then at the end of the presentation, we will send out a Q&A handout to participants with any additional questions and answers. Angie Murdo is a shareholder from our Helena office. Chad Miller, a shareholder from our Havre and Bozeman office, and Don Lane, CEO, round out our team of experts. This team has studied the CARES Act, any interim final guidance, and FAQs issued by the SBA. They've attended numerous sessions from the AICPA, American Institute of Certified Public Accountants, and they've worked with bankers and other resources in order to gain their expertise. So I'm very proud of all the hard work this team has done, and hopefully we can provide some answers in these trying times for you participants. A couple of additional items to note. Information that we cover today could change tomorrow as further SBA guidance or legislative changes happen. If that happens, we will be sending out those updates to you in email blasts as they occur. Also, if you would like a copy of today's presentation, please reach out to your CPA or AZ representative to request a copy. And finally, please keep your audio on mute and submit any questions that you have using the chat button. You can also reach out to your CPA, and if they don't have an answer, they'll get it for you and get back to you. And with that, again, thank you for joining us, and I'll turn this over to Jim Woy.
Okay, thanks, Steph. Appreciate it. Hello, everyone. This is quite a big turnout. I'm very pleased to see the numbers that we have, but yet more important that those of you along the call here are hopefully going to feel like it was definitely worth your time to sit in, especially if you've been touched up to this point by the PPP program. Let me assure you as we go through this presentation that some of the slides may appear on the surface to be a bit overwhelming, but they're really more meant to give you, the participant, a visual of how things will look from your end if you're going to be generating the documentation to support the debt discharge in the application. I cannot encourage you more to throw questions out at us. There's individuals, as Stephanie indicated, that will be monitoring the questions, and that we have plenty of time to talk about those questions and answers at the end of the presentation. Okay. We're talking about the SBA's Paycheck Protection Program application for debt discharge. Huge, because a lot of you have received these loans. You've got them on your books as loans, and they will continue to be loans until you submit an application that meets the lender's requirements and obviously the SBA's requirements. And it could be 60 to 90 days before you're going to get notice that that debt that is currently on your balance sheet is going to be discharged. As Stephanie mentioned, there is daily updates to the PPP program. You should check www.treasury.gov on a daily basis, because it is clearly a moving target as we work our way through this coverage period that so many of us desperately need this money. Over the Memorial Day weekend, Treasury and the SBA issued their third interim final rule. Okay, 3 interim final rules, and who knows what's to come. But surprisingly, much of the third interim final rule supported the application that we all are now aware that is out in the public domain that we need to complete as borrowers under the PPP program. I'd like to start off and ask everyone this basic question, or I would like each of you to think about this for a minute. Should I have applied for this stimulus program? I've been getting a lot of questions from clients about, you know, Jim, it almost seems too good to be true. Should have I really applied? You know, the impact to my business, yes, there is an impact, but I really can't quantify it right now. I don't know if really this was meant for somebody way more desperate in terms of their ability to operate as going concern. I'm a little nervous about it, and I hope to basically share with you some thoughts on that question you may have asked yourself or others. You know, are you entitled? Are you deserving? You know, sometimes programs come out, they come out very quickly, and quite candidly, this one came out and I had clients say, wow, is this too good to be true? And so what we need to do is break down the facts a little bit, try to mitigate the confusion that is out there to help everyone answer that question. Should have I applied? Added to this confusion is the second interim final rule that was issued back on April 23rd, in which basically that rule came out and said, you know, if you apply for these PPP loan programs, okay, it was meant for the economic uncertainty that we're all facing due to the pandemic, and to help you support your operations, and more important, you know, keep your people employed so they stay off the unemployment lines. Unfortunately, as the second interim rule came out and was studied by several experts, a question arose about, well, what if I had a small business, but I had a large line of credit that I hadn't tapped yet? So I had access to capital, or I had other types of access to capital. Maybe I could borrow money from my general partner, my limited partners, if it was a limited partnership or an LLC, some of my other members. Or maybe, you know, I had a corporation and I could issue stock. And so a lot of questions came forward about, whoa, you know, are they moving the goalposts on us? And should have I applied? And clearly, question 31 of the most current Q&A that was issued in May 19th really brought this to life as a true question. So this confusion continues. By the time many entities applied for and received these PPP program receipts, you know, they were applying back when the first rule was out there that said basically apply if there's uncertainty regarding your business and you need this money to support ongoing operations. That, in a nutshell, is what prompted the huge numbers of small businesses to go forward. So business entities, specifically publicly held companies that originally applied for and received funds, had until May 18th of 2020 to return them. They did so maybe because they were worried about an audit, maybe they were worried about potential penalties, maybe there was just a lot of negative press that they didn't want to be in the middle of if somebody said, wow, can you believe ABC company applied for this program? It really wasn't meant for that type of an entity. And let me assure you that these type of thoughts are out there. And subsequent to the initial rule, as I mentioned, under the April 23rd rule, there was some real concern. And as we now know from some press, over $1 billion in funds went to 300 publicly held companies. So many companies have not returned the funds due to these changing goalposts and the belief that they appropriately relied upon the rules that were in place when they made application. I continue to stress that point, that is appropriate, that is appropriate. Maintain your due diligence dealing with the program, and work through the debt discharge, but recognize that when many of us applied for and received these funds, the rules were very, very clear that just about everyone that met the small business criteria, in fact, was deserving. Many of us now know that small businesses with 500 employees or less went forward and applied for these monies. In late March, there was some guidance that said, hey, there's an alternative size standard where companies with more than 500 employees and who had a net worth of less than 15 million at a certain date and whose average net income for the past 2 years was $5 million or less could also participate. And thank goodness for that, because a lot of not-for-profits that have an exempt purpose of providing services to many in need people, they have a lot of payroll, they have a lot of employees. And so initially they were carved out, but thank goodness for the alternative size standard, a lot of larger nonprofits were able to participate, and that was a good thing. A major objective of Congress with this program is to keep your employees employed and away from the unemployment lines, as mentioned earlier. It's about job protection, right? The world is facing a health pandemic that no one, absolutely no one, could predict. And you cannot predict the impact this will have on your business in the coming weeks, months, and potentially even longer. I assure you, when you ask yourself this question, should I applied for these program dollars? I believe the answer is overwhelmingly yes. You should have. You should feel good about that. And now we're going to help you keep as much of this money as a grant and not as a loan that is subject to repayment over the next 2 years. Okay? So let's move to the next main section of this update today. Some practical guidance on understanding and preparing the application. Again, don't get lost in the details. Allow me to communicate. What I'm trying to do here is communicate so that when you're sitting down with your payroll person or persons and your accounts payable people and your other accounting personnel and coming up with the plan to arrive at your first preliminary amount of dollars that are going to be subject to discharge, you'll have a better understanding, a better feel based on this practical update. What do you need to know? The Treasury Department and the U.S. Small Business Administration, SBA, released their first draft of this loan forgiveness application, okay? And I'm pleased to report that even after the third final rule, the interim rule that was issued over the Memorial Day weekend, many aspects of that application are still in play, okay? So this presentation will be very beneficial for all of you wanting a good understanding of how do we determine how much of this loan do we get to keep to help keep our employees employed, to help keep our businesses a going entity, if you will. Okay? Okay. So let's talk about some of this practical guidance. First of all, read the form. It may appear overwhelming, but it's actually a pretty good read, right? Solicit the help of your CPA or accountant who understands your business and understands the PPP program. Where there may be some shades of gray or areas where there is not a lot of clear and concise guidance, they will work for you. It's so critical. Realize that spending a little bit of time and money to get the maximum discharge is definitely the smart thing to do. Believe me, it's an opportunity to maximize the grant that the government is sharing with you to help you keep your small business going. Don't cut corners from that perspective. Avoid trying to do it yourself if you're not comfortable with the program. Understand the big picture and be a reviewer of what somebody may present to you. The key point, and I don't want to underestimate this, is many borrowers that might have done it themselves probably didn't actually get the full amount they were entitled to, simply because it was such a quick process. And as more and more information came out, more and more details were clarified. But, you know, we got to just use the best common sense out there to get the maximum, get somebody working for you from the standpoint of getting you your maximum benefit. Let's start with some key definitions. What is going to be part of the discharge? Well, it's going to be compensation paid, gross salaries you pay to your employees over your covered period, right? It's going to be limited, obviously, at certain points along the way for high wealth individuals, where the maximum that one can use for purposes of reimbursement or grant forgiveness will be based on some dollars that you will get into here in a few minutes. But keep in mind that, you know, there's a lot of questions out there. Do you have to reduce your gross compensation by deferrals into 401k, or do you have to reduce compensation by amounts that you put into a health savings account? No, it's gross comp paid to your employees over this 8-week covered period, okay, with limitations on the high wealth. Okay, average FTE. I'm going to walk you through a very simple and straightforward approach to calculating FTEs. This is an important calculation because it's going to determine if there's going to be any reduction to what you're entitled to as a debt discharge. Okay, so we'll talk a little bit about average FTEs. And I want to point out that there is a simplified FTE method, where you get to assign a 1.0 for each employee working 40 or more hours, and you assign a 0.5 for each employee working less than 40. Why did they do that? Well, this simplified method was brought forth because a lot of employees don't have time clocks. They don't do time sheets. And so for the employer, how do I really calculate an appropriate FTE? Well, you can take this simplified method because you know you have several employees that don't work 40 or more hours a week, and you have a whole lot of employees that work less than 40. So without good documentation, you may find this simplified method is the cat's meow, so-called, okay? Salary and hour reduction, yes. Unfortunately, if at any certain point within some of these key dates and ranges, you reduced an employee's hourly rate, say from $15 to $12, or you took a salary of $80,000 down to $72,000. If you've made some of these very important business decisions, you will potentially have some negative impact on the amount of your debt discharge. However, if you reinstate your individual's hourly rate or your individual employee's salary to their old rates before the pandemic, then you can avoid having any reduction. So you would look to a date like at June 30, 2020 and see where you're at, and maybe by that date you reinstate some hourly rates, some salaries, and you're going to be okay. And if a reduction didn't exceed 25% of that individual employee's hourly rate or salary, then you can ignore that deduct. So there is some pretty good things there from that standpoint. So some additional practical guidance: document, 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 because you're going to need it. And as we learned over the weekend, and we'll talk more about this in a little while, SBA has up until 6 years after they approve your debt discharge to come in and check your numbers and check your documentation. But some key dollar amounts to document right away to start your estimation of what portion of your PPP loan will be discharged or expected to be discharged. Document the PPP loan amount exactly as deposited when you went through the application to receive the loan. Document the date that the loan was dispersed. Clearly a key date in this application, because it sets forth the covered period of 8 weeks, assuming you don't elect an alternative covered period that we'll talk about. Document the first date of the pay period following your PPP disbursement. Okay, a little more about that in a couple of minutes, but just make a note of these things. The alternative payroll covered period election is out there for you to make if it works to your advantage. You can elect this alternative payroll period if you are on a weekly or bi-weekly payroll period, okay? So again, some of these terms may appear a little foreign to you, but just bear with me here, okay? Document once you pick your covered period, because you have an option we're going to talk about. Pick the beginning date of that option period, okay? The covered period, if you will. And then document the ending date. Ultimately, you're documenting an 8-week period that is going to be the ability for you to incur costs that are eligible for debt discharge as well as payroll costs. This is probably one of the most important decisions that everyone out there that will be working through this debt discharge has to make. Option 1, use the actual 8-week covered period. Well, what does that mean, Jim? Enter the 8-week period, 56 days of your PPP from the date you received your PPP loan proceeds, okay? So enter that 8-week period, okay? And basically, if the borrower received its loan proceeds on Monday, April the 20th, the first day of the covered period is April 20th. It is the date that the loan proceeds hit your bank account. And the last day goes out 8 weeks or 56 days, okay? In a nutshell, what that means is you have to count April 20th as day 1. So you would go out 55 days after April 20th, and that would take you to Sunday, June 14th. That's your covered period under this option. So payroll incurred, payroll paid during this period is going to be eligible for debt discharge against your PPP loan proceeds. Now, it's not as simple as that, and let me illustrate as I take you through the second option. If you go option 2, you're saying we're going to use the alternative covered period. Personally, I like the alternative covered period because it really seems to make more sense to somebody like me. But maybe you like the period from the date that the proceeds actually hit your account, going out 8 weeks from there. I like the alternative covered period. And only those of you that are on a bi-weekly or weekly payroll schedule can elect this, okay? But again, this 8-week period will start on the first day of the first pay period subsequent to the loan disbursement of your loan proceeds. So what does that mean? Let's look at an example, okay? So if the borrower received its loan proceeds on Monday, April the 20th, and the first day of its first pay period following that loan disbursement date is Sunday, April 26th, because for most weekly and bi-weekly pay periods, it usually starts, the new pay period starts Sunday. You know, it's usually through Saturday, and then the new pay period starts on that Sunday. So if in this case, Sunday, April 26th is the first day of the new pay period after receipt of your loan proceeds, that starts the 8 weeks period. It starts on Sunday, April 26th and goes out 8 weeks, all right? Okay. I like this just as an FYI, okay? So take your actual and estimated payroll numbers for the covered period. Once you've now determined if you're going to use the actual 8-week covered period, starting from the date the money is deposited, or if you're going to take the alternative period, which allows you to go out to that first day of the next payroll period, and then estimate the remaining 1 or 2 pay periods. Probably by the time you sit down to do this now, this week, there might be 2 or 3 pay periods remaining is all. And it will be a good exercise to help you get a good idea on how much payroll related costs are going to be available for your PPP loan discharge. Okay, so let's take a minute and look at this screen. Now I apologize, I know it's numbers and columns, and except for accountants, it's probably something that a lot of people say, oh yuck, I do not like this, Jim, simplify it for me. Well, I'm going to do that. So basically what you're looking at is some facts for a company's first pay period that ended April 20th or starts on April 20th. It's the first pay period that starts April 20th. This company has 15 full-time employees. Hell, they've been working full-time for up to number of months and years, but for whatever you might just say, they have 15 FTEs that are working 40 hours or more per week, okay? And they have some part-time employees, 4 to be exact, that during this first week that started April 20th, worked a total of 100 hours. So how do you convert those 4 part-time employees that worked in total 100 hours to an FTE equivalent? Well, you take the 100 hours and you divide it by 40 and you get 2.5. So that becomes the number of FTE equivalents for all of your 4 full-time employee or part-time employees. So you have 15 employees that are full-time, and then you have 4 employees that are part-time, but when you take their collective hours in that first week, divide by 40, you get 2.5 equivalent FTEs. So the week of April 27th, we didn't get rid of any of our guys and gals that work full-time, 40 hours or more a week. So there's 15. And the 4 the 4 part-time folks worked collectively 110 hours. So the FTE equivalent becomes 2.8, which is 110 divided by 40 to get you to that 2.8. And by the way, you can round up to the nearest 10th, okay? So again, that's how you would do a calculation of FTEs for each week that you would be in your 8-week covered period. Now, some of the supporting spreadsheets that will support the April 20th numbers you see there and the April 27th numbers, you'll have a spreadsheet listed by employee. Every employee will be listed, his or her status. Are they salaried or are they hourly? What is their salary or their hourly wage on February 15th? Key date. Your supporting spreadsheet should show that individual's hourly rate or salary on 2/15. Then that same spreadsheet should show the average annual salary or average hourly rate paid between the periods February 15th and April 26th. Okay, so you're going to also on your supporting spreadsheet calculate the average annual salary or average hourly rate for each of your individual employees during that time period. Why? Why that time period? That time period is critical because the April 26th date really represents 30 days past the adoption of the CARES Act. And February 15th becomes the date that things kind of really got pretty stressful in the world of small business. Okay. Your supporting spreadsheet will also show the average salary or average hourly rate as of June 30. And quite honestly, that should say not average, it should just say annual salary or annual hourly wage as of June 30. Why? Because that's a point in time. And if you bring your people's hourly rate or salary up to that June 30 date to where it was before the pandemic problems and the reduction in force or the reduction in wages or salaries, you are golden because you will have reinstated your key employees by that date. So that's a key metric in this supporting schedule. And then no doubt you have to list their weekly gross wage and hours worked during each of the 8 weeks that you will be tracking within your covered period. And this information will take you right up to the totals that you see above on this spreadsheet. And as you see out there to the right, retain these records for 6 years after the date of notification that your loan has been forgiven, because unfortunately, SBA could and may very well be wanting some audits done of small businesses in this regard. Okay. So now let's move forward, and you're looking at the summary for the 8 weeks. Now, I want everyone to just realize that May 11th through June 8th is a hypothetical here, and I'm just saying that for purposes of illustration, there were 15 employees during each of the weeks, May 11th through June 8th. So that you're really looking at a 8-week covered period, but I just decided in the 4th line down to make May 11th through June 8th the same. So basically, you bring in your FTEs that are full-time. There were 15. Enter number of part-time employees, okay, and then come up with your FTE equivalent for your part-time employees, as you can see there. And then all the way out to the right is your weekly average, okay? So what you're looking at is at the very bottom to the far right, you'll see I added up all the weekly average FTEs for this hypothetical business, and I ended up with 136.3, and I divided by 8 weeks, and that's how I got to the 17.1. I updated this slide over the weekend for a couple of things, and it never got fixed, I guess, but the 69.1 divided by 8, just ignore that. But anyway, basically, that's how you arrive at your average over the covered period. You'll take each weekly FTEs calculated, 17.5 on the 20th, 17.8 on the 27th, 17 on the 4th, and for each of the remaining 5 weeks in this hypothetical, 16.8. But in all reality, that would not probably be the case, but I did it for simplification purposes. You add those up, you come up with a total, divide by 8, and you're right there with your average FTEs for that 8-week covered period. Okay, let's move on. Some practical guidance on the payroll costs. There is a schedule on the application for debt discharge called Schedule A. This is the most important schedule that you want to focus on. Why? Because there are 4 key sections to this schedule that, when completed, will get you right down to where your payroll costs have been computed for the amount that you're going to get as debt discharge. So table 1 is going to be for all of your employees. And if you look at the screenshot, for all of your employees that make $100,000 or less in the, on an annual basis. So in this case, I'm just using 2 employees in this hypothetical company. So P-Pen basically worked received $1,200 over the 8-week period. Now that's low, and over the weekend I fixed that slide to make it look like it was more like $4,800. But don't get focused on the dollars. I apologize that some of these slides didn't get updated from my own errors when I originally wrote the slide deck. But keep in mind that you have P-Pen, and for the 8-week period, okay, for that 8-week period, he had $1,200 of compensation. He's 1 FTE. C-Can is also 1 FTE, and he earned $2,000 over the 8-week period for a total of $3,200 gross payroll made out to the 2 employees. Okay, so that becomes table 1. When you go back to the 4 parts of Schedule A, table 2 says now focus on those employees that make more than $100,000 per year. So when you look at the next table that I have here as a screenshot, you'll see that the cash compensation for the covered period is limited to $15,385, which happens to be $100,000 times 8 weeks over 52 weeks. Okay. Again, if you make over $100,000 a year as a highly compensated employee or owner, but in this case we're only dealing with employees that make over $100,000, you would limit it for the covered period to $15,385. Again, average FTE is 1 for Mr. Van, and average FTE for Mr. Zan is also 1, and the total covered period gross wages would be $30,770. Okay, so bear with me. So table 1 is the table for all employees making less than $100,000. Table 2, employees making more than $100,000, and obviously for the full 8-week period, you're going to list their total compensation, and you're also going to document their average FTEs, the average FTE that will be calculated if you have a combined, full-time and part-time employees, which many of you will. But I'm just doing this in a simple fashion. And then off to the far right, you'll see on this table 1 where you would have a reduction if you basically reduced a person's hourly rate or their salary during this covered period. And again, there's exceptions that will allow you to keep zeros in that column if you reinstated their payroll, hourly rate, or salary by June 30th, or for some other exceptions that are in the law or in the rule. The third part of the PPP Schedule A is for the owners. Okay, the owners that own the business, and again, that section would be for just owners, and you would have the same rules where you can't include more than the max, which is 8/52 of $100,000. Okay, so you kind of got a picture of how the 3 schedules or the 3 tables come together as we work through Schedule A for payroll costs. And then the most important part is what I'm about to talk about in the area of FTEs. So this is important. You need to realize that you get another decision here. Do I choose a reference period that goes back to 2019, or do I choose a reference period that starts in January of 2020 and goes out to February 29th, 2020? And so this is your second major decision one makes as it relates to comparing their actual covered period FTE, average FTEs, to the FTEs that are calculated, the average FTEs that are calculated using the reference period you select. So your first option, I'm going to select the period February 15th of 19 to June 30 of 19. So you're going to go back and you're going to calculate your average FTEs for each of the pay periods within that time period. That's option one, okay? So option two says you can pick a reference period from January 1 to February 29th of 2020, okay? So wow, I can have a reference period that goes all the way back to February of 19 and to compare my current average FTEs to see if I have to take a haircut on how much of my loan can be discharged. Option two says use the January 2020 period up through February 29th. So one might ask, which one works best? Well, if the key point here is if your FTEs, your average FTEs are higher in the January 2020 period compared to the 2019 period, you would want to use and elect the 2019 period. Because remember, your reference period, you hope, will reflect a lower average FTE than the actual covered period that you're going to use, the 8-week period for that discharge. Okay. Again, a lot of information, but very clear kind of where you might fall where you were at the end of or during that early part of 19 compared to the early part of 2020. Okay, so we're still in the last part of this Schedule A, calculating your FTE reduction. Now, you're going to get to this section, and if you come up to this and you can answer this question, yes, you are in great shape. You had no reduction in the number of employees or the average paid hours between January 1, 2020 and the end of your covered period. If that can be answered, this is a correct statement, then you have no reduction against how much you can reduce your PPP loan for or by because you basically did what the government really wanted you to do, is keep your employees employed, and basically you paid them based on hours that were basically not reduced by no compensation reduction. But if there was a reduction in your average FTEs, you have to now compare your average FTEs during the reference period, which is the period you get to select. Okay, either go back to 19 through that period, or take January of 2020 through February 29th, 2020. Pick your average FTE reference period and compare that to your actual FTEs that you computed during your covered period. And it happens to be, and let me just quickly take you back here, it happens to be this schedule right here where you would see how you've done and calculated your average FTEs, which down at the bottom you'll see is 17.1. So if 17.1 is your average during your 8-week covered period, okay, stay with me here, right? And you can say that for the 2019 period I just alluded to, or the January 2020 to February 29th period I alluded to, if you pick one of those and you can come out with a greater FTE than 17.1, you're going to go ahead and have to take a reduction, right? Because you had more FTEs during the reference period, average FTEs, than you will have during the covered period. However, if you see here in my example, if you had 18 FTEs during the reference period and you had 17.1 during the covered period that you saw me calculate a few slides ago, you would see that you now have a reduction. We call this the FTE reduction quotient that you would have to put on that Schedule A. But again, there's always some good news if you can reinstate, you know, some of these people back into your employment before June 30. You're going to be okay. Okay, so there is some safe harbors here, and again, without getting into a great amount of details, just realize that you can also compare your average FTEs for the period 2/15 to 4/26. And remember, let me just remind everybody, back on that schedule I showed you, you're going to have that period as well in one of your supporting spreadsheets, because those average FTEs could be pretty important as you look at your average FTEs during the pay period that is inclusive of February 15th. So, and again, on my supporting spreadsheet that I showed you a few slides ago, you're going to be having those averages or those FTEs built in there. So again, there is some safe harbors, and if you can get people back employed by June 30, I think you're going to find that you're not going to have any reduction as a result of the FTE quotient factor that I just tried to quickly walk you through. There'll be some questions, I'm sure, on this, and we look forward to answering those for you. Okay, so options available to maximize your debt forgiveness. What do we now know? Okay, you get to pick the period to which you're going to start your 8-week covered period. We talked about that earlier. Okay, you're going to get to pick the reference period to compare your FTEs, average FTEs you calculate during your covered period, to one or two of those dates that were identified a couple of slides ago, right? You can pick an FTE simplified method, because many people don't maintain timesheets, they don't maintain time clocks, and so you may want to just go back to this safe harbor and assign a 1 for every employee that works 40 or more hours, and assign 0.5 for employees that work below 40 hours. Okay, other payroll costs you don't want to forget to pay during the covered period. Health insurance. That includes self-insured group health premiums. It includes insurance premiums, and you know, you don't get to, but you do exclude any pre-tax amounts that employees took out of their checks that you may have in fact withheld from them, and then you paid the health insurance premium. You don't get to have, obviously, that portion of the payments, just the employer costs associated with health insurance. Retirement contributions. Okay, 401k matches, pension, discretionary profit sharing contributions. Here's a little thing to think about. Your covered period is going to be in your year that you file your 2020 tax return. You may not have even decided yet if you're going to do a discretionary profit sharing. Okay, maybe you are going to do a 5% pension payment, because that is a payment that is set forth in the plan, maybe. But the discretionary profit sharing is usually calculated after the end of the year, and when the company either has made some money or not made money, and a decision is made on a discretionary. You can still take 8/52 of your 2020 profit sharing contribution if you're going to fund at least that during the covered period. So I'm of the opinion that if a company has consistently done a discretionary profit sharing at the end of the year, let's just say at the end of each year they do an additional 100 over and above the match. Take 8/52 of that 100,000 that will be, and pay that into the plan during this covered period, right? Why? Because let Uncle Sam help fund 8/52 of your current year. If you're doing a contribution now for last year, you don't meet the requirements under the rule that says you have to have incurred the profit sharing. Okay? If you're doing it for a calendar year company and you're making the payment in May or June of 2020, that doesn't qualify. because it was earned by your employees back in 2019. So consider looking forward and consider getting 8/52 of that contribution paid into the plan. Now, obviously, you got to commit to that. You can't say I'm going to do it and then pull the money out because your year has kind of gone into the negative or whatever. But again, be aware that that's an option. Okay, state employer taxes like SUTA can also be included as additional payroll costs. Okay, eligible non-payroll costs. We've been learning a lot about this lately. Okay, you're a small business and you pay rent expense, right? You pay rent expense, and it could be on real property. It could be a building that you own or that you lease from a related entity. It could be personal property. Maybe you're a construction company and you lease personal property from your related party leasing company. Well, as long as you have a lease document that was in place before February 15th of 2020, you can take the rent expense incurred over your 8-week covered period, okay? And make sure it gets paid, right? Make sure it gets paid, okay? If you have a mortgage, obviously the mortgage payment that you make during this 8-week period has to be for that 8-week period. You cannot prepay mortgage interest. You cannot prepay rent on real property or personal property. You have to incur these expenses in order to get the ability to use these against your PPP loan, right? So, and the mortgage had to have been in place, the mortgage obligation on or before February 15th of 2020. Same with, as I mentioned, the lease document. Okay, covered period utility payments. This is a biggie. Every business pays electric bills, pays gas bills, water bills, telephone, cell phones, right? Internet access, transportation. OMG, transportation expenses under utilities. What in God's green earth are they thinking of as it relates to transportation? Heck, I don't know. I still don't know to this moment. But maybe somebody has some creative transportation cost that fits within the utility expense category. I was thinking maybe if you're an agriculture borrower and you have to pay to have fuel taken out to your tanks out in the middle of your home place and ranch, then maybe, obviously those costs would be transportation. But someone asked me one day, what if I have a company that, I have employees that lay internet lines and they go into locations and bring internet lines in and connectivity to the internet, and they have to drive from their home base to their customer's place of business. I would say, heck yes. Don't lose sight of the fact that that's a transportation. So if you're paying somebody 58 cents a mile to run to Butte to lay some fiber optic cable or to run some internet cabling, my goodness, that's transportation. Now, is that a little gray maybe? I don't know. I don't think so, but that's just my opinion. But, don't lose sight of the fact that there isn't going to be the golden rule, black and white for everything. You have to have a little bit of ability to say, could I support this? Does it make sense? That's why you pay me to tell you, could I sell this to the IRS? Could I sell this to SBA in an audit? Well, if I say I can sell it, damn it, I'm going to do all I can to win that argument. But again, that's the point. Recognize that there isn't everything here that's black and white. Now, key point. No more than 25% of your loan proceeds can be discharged, forgiven with these non-payroll costs, okay? So payroll costs are still the big dog in the proverbial kennel, right? Those are the big dogs. Those are the dogs that we have to really be looking out for, payroll costs. That's going to be the bulk of what you're going to get in terms of debt discharge. So, key point. The non-payroll costs must be paid within the covered period, or, and this is a great clarification, has to be incurred during the covered period, and as long as you pay that rent bill, that utility bill, before the next regular billing cycle for that invoice, you're golden. So you can actually make the payment outside of the 8-week period as long as it doesn't go out any further than the next regular invoice. So Northwestern Energy bills me $680 in July, and it covers a few days or a week or so of my covered period, but I don't pay that utility bill until the 1st of August, I'm still golden. Why? Because I'm going to pay it before the next regularly scheduled billing for that monthly cost. Awesome. Perfectly legitimate, and we got to just be in our best game to be sure we're paying these expenses timely. Don't be late, doggone it. If you're late, you're not going to get the benefit of using that against your debt discharge. Okay, I'm going to end really quick here with some things that came up over the weekend. What is the borrower responsibility? You're going to go to your bank when you get through your 8-week covered period, or you get through your June 30 period, if you're thinking that by then you're going to reinstate wages or salaries or FTEs, you may end up waiting to June 30 and get that period behind you before you do your full application for forgiveness. Doesn't mean you shouldn't be doing it now to come up with estimates, which I strongly recommend. But you would provide an accurate calculation to your banker, right? Because you're responsible to do an accurate application for discharge, and you have to attest as to the accuracy, right? To the accuracy. Okay. In addition, you shall not receive forgiveness without submitting all required documentation to your bank. So your lender has to get those supporting spreadsheets I spoke of earlier, copies of your quarterly reports to help support maybe one or more of the expenses, canceled checks on rent payments, canceled checks on utility payments. Again, all of the required documentation supporting that application for discharge has to be submitted to the lender. What's the lender's responsibility? Okay, they're going to issue a decision on loan forgiveness to the SBA. They have 60 days from when you give them your application complete. They have 60 days to make a recommendation to SBA as to whether all or a part of that loan should be forgiven, okay, based on the application. They have to act within 60 days, your banker. The lenders are expected to perform a good faith review in a reasonable time, no more than 60 days, of your calculations and supporting documents. Can they take a cursory review and say, oh my goodness, Jim Lloyd did that, I don't need to look at that? Well, they can, but they're going to be responsible to have met this rule that says, don't just take a real cursory review, but make sure you got calculations that appear correct and that the supporting documents appear accurate, and bam, send them off, or not send off the documentation, but send off the application then to SBA. If the lender identifies errors in your calculation or believes there is a lack of substantiation in the supporting documents, he or she will work with you, the borrower, to remedy that issue. Okay, finally, and I'm done talking after this, so we can take what is most important, some questions, and hopefully get some good answers. What's the SBA's responsibility? SBA will, folks, subject to any SBA review of the loan or loan application, remit the appropriate fee forgiveness back to the lender plus accrued interest from the date the money hits your account up to the date of payment, no later than 90 days after the lender issues its decision to SBA. So basically, the lender has 60 days to get the money or to get the application and recommendation for forgiveness to SBA. SBA has no later than 90 days after the lender issues its recommended decision to SBAs to forgive or not forgive, to go ahead and get the money back to the lender, who will then basically credit your loan. This 90-day rule is due to a large number of, as I said earlier, people were just moving at light speed trying to get this loan, and there might have been some errors in how it was calculated, and SBA wants some time to properly review to be sure that the debt discharge is going to be accurate to the extent possible. Again, I am absolutely not worried about the SBA, because everything I touch is going to be absolutely appropriate once finalized to get your reimbursement and to get your debt discharged. So get the bank's reimbursement and your debt discharge. So looking forward to this next process. But with that, I am going to stop now, and I am going to ask Megan to take over the microphone and possibly throw out some good questions, Megan, that we can answer for the benefit of our great participants today.
Wonderful, thank you, Jim. And I apologize, of course, today my camera stopped working, so you'll be staring at a black screen. I'm going to start off with some pretty basic questions, and then I'm going to try and answer some of the questions that came in during the chat. Of course, there were a ton, and so whatever ones we don't get answered today during our session will come out in a Q&A PDF that we will provide to all of the attendees today. So the first question I've got is the forgiveness amount for non-payroll costs based only on costs incurred and paid during the covered period? And of course, we know no, it's payments that were made during the covered period plus any incurred and paid by the due date. I did receive several questions in there about maybe some past due, payments for mortgage interest or utilities for maybe several months back, and if those are allowed, and I don't know the answer to that at that time, so I will look into that, include in our Q&A. The second question I have is, if I elected to use the alternative covered period, do I use that same period for non-payroll related costs? No. The alternative covered period is for payroll costs only. All of the other non-payroll related costs for lease payments, mortgage interest, and utilities will be utilized based on the covered period beginning on the date of the disbursement of the loan funds. The next question I have is, every employer allowed to choose the alternative covered period for payroll costs? And the answer is no. That is specifically just for biweekly or more frequent pay periods. So if you are semi-monthly or monthly, you are not allowed to choose that alternative period. Next question, are you allowed to prepay non-payroll related costs and include this in the forgiveness calculation? Yes and no. Mortgage interest was specifically identified by the SBA as something that you are not allowed to prepay. However, the application and the newest interim final rule do not specifically disallow prepayments for rent, lease, or utility obligations.
Megan, on that point, I'd just like to add that I'd walk very carefully through that mine loaded field, because there's a lot of discussion about we don't want to create a situation where you're prepaying expenses that were not incurred during the covered period. I know they might have been silent, but even I would be cautious about prepaying rents that are under a defined lease agreement, or obviously we know mortgage can't be, but I'm pretty comfortable that's not going to be something that you're going to want to be doing. Just my opinion.
Thanks, Jen. The next question is, when does an EIDL, the idle loan advance, reduce the forgiveness amounts? If you apply for both an EIDL loan advance and the PPP loan, the amount of the advance up to $10,000 is not allowed to be forgiven. Therefore, it's going to reduce your PPP forgiveness amount. Next question. If I continue to pay furloughed employees or provide bonuses during the covered period, are those costs included in the forgiveness? Yes. So furloughed employees, as long as you keep paying them what they were being paid and don't exceed the annualized salary of $100,000, you can include those costs. Kind of the same thing with bonuses. The interim final rule did specifically point out that if an individual has an annualized salary of $100,000 or more, that bonuses wouldn't count, but really that kind of negates, because you would have already hit the max with their salary that you were paying, but they did specify. So maybe if that pay period, they didn't hit that max for 15 through 85, but they will by the end of the year. For the annualized salary, you cannot include the bonuses for those employees only. So next question is, does the lender or the SBA determine final forgiveness? The forgiveness is first determined by the lender, who has 60 days upon receiving your forgiveness application to send it to the SBA with their determination. Then the SBA has the right to review that along with the loan application, and then they have 90 days from the day the lender notified them to remit the forgiveness amount. Next question, if I'm a seasonal employer, am I allowed to use a different FTE reference period outside of the standard options of February through June of 2019 and January to February of 2020? And yes, if you are a seasonal employer, you are allowed to choose any consecutive 12-week period between May 1st of 2019 and September 15th of 2019. Next question, how are payroll costs determined for owner employees or self-employed individuals? So the first part here, because obviously there's several factors that play into this, is that the forgiveness for these individuals cannot exceed the lesser of 8/52 of their 2019 compensation as filed on their tax return, or $15,385, which is the cap for an annualized salary of $100,000. So for owner employees who receive wages, you use the 2019 wages and health insurance and retirement benefits paid. For Schedule C filers, your owner compensation replacement is based on your 2019 net profit as filed on your tax return. For partnerships, the general partners use the 2019 net self-employment earnings, which are reduced by several items, including the claim section 179 expense deduction, any unreimbursed partnership expenses, and depletion from oil and gas properties, and then you multiply that by 0.9235. And the interim final rule also indicated that for Schedule C and general partners, no additional forgiveness for retirement or health insurance contributions are included, as those are paid out of their net self-employment income. The
You know,
next
Meg,
question, yep.
Meg, that's a huge point that I'm really glad you mentioned, that if you're a sole proprietor or a general partner in a partnership and your self-employment income is calculated based on your 2019 taxes filed, you got to remember, you don't, unlike an employee, an owner employee, say of an S corp, you don't get to take the health insurance that person paid, or retirement contributions. That's a big deal, isn't it? That's a big deal. Yeah. Was that in the original second or first rule, or did that get clarified just this last weekend?
Just this last weekend.
That's huge. That is absolutely. It makes me really feel good about all those sole proprietors we incorporated over the last few years, so that they get the benefit of at least getting their health insurance and their retirement included. Anyway, thanks, Megan.
Okay, next question is, will my loan forgiveness be reduced if I laid off an employee and offered to rehire them and the employee declined my offer? And the answer is no. There are some guidelines that you have to follow. So first, you have to make that offer to them in writing and maintain documentation of their response. That doesn't necessarily mean they need to sign a form saying they rejected your offer, because most of the time those things are probably done via telephone, but you need to maintain documentation of the rejection. And then the other thing that came out with the interim final rule this weekend is that you have to inform the state unemployment office within 30 days of the rejected offer. They did indicate that they are going to update the SBA's website to provide further information on how to report this information. Related to this, if an employee is fired for cause or resigns voluntarily, will this reduce my loan forgiveness? And no, you're allowed to count that employee at the same FTE level they were before they were fired or voluntarily resigned if you did not hire another person in their position. So if they've been fired or resigned, you still haven't found someone, you're doing your FTE calc for this week, you can include them at the same level they were at before. Next question, any wage reductions are wage reductions in total or employee by employee? And like Jim mentioned, this is going to be employee by employee. So you're going to have a long list if you've got a lot of employees, but the good thing is that you don't have to take into consideration any employees that make more than $100,000 in this calculation. So that should hopefully reduce some of them. But yep, you're going to have to look at this by employee.
You know, Megan, on that point too, it's important to note that, you know, I'm hearing out there that a lot of employers have made an attempt to rehire some employees that were furloughed during some of the major, you know, areas of pandemic concern. And a lot of them are making more money on unemployment right now than they would have been making at their regular job. And so they may have declined. And so, as you mentioned so clearly, there is a place on Schedule A in each of those tables there is a line item that allows you to add back anybody that was not employed, but you offered to rehire them and they rejected your offer. And so that's huge. And make sure you also communicate that, as Megan said, to the state unemployment offices within 30 days of that rejection.
Okay, next question. As this came up a lot, and it has, and they finally issued some guidance on this with this last rule, is that they have established how it will be taken into consideration so you don't get double penalized for an FTE and a wage reduction. It will essentially be one or the other. So if you reduce somebody's salary, but they're still maintaining the same hours worked, they're only going to be considered in the salary wage reduction. Obviously, their FTE amount stays the same. But if you reduce both wages and the hours, and the wage reduction is more than 25%, you might see a slight reduction for both, but that's because you've reduced both. But if it's one or the other, you're only going to have to take it into consideration for the one in which it applies. Okay, and now I'm going to start sorting through some of the ones that came up during the chat and that we were able to develop some answers for that might not have been covered with the presentation or what we anticipated. So there is a question in here about if the loan is forgiven, do we have to pay taxes on the forgiveness? And that is still undetermined at this time. We believe that that wasn't the intent of the program, and that with future legislation hopefully coming out this week, they will change what the IRS had further said, that the forgiveness amounts aren't included, but you also weren't able to deduct the expenses and costs that the PPP funds were used with. And so that's still undetermined at this point, but we hope we'll get some further guidance this week. Okay, next question. We covered that one. Will we have to spend, so if we document that we spend 79% of the loan paid out within the 8-week period, but you haven't spent 100%. So likely the amount that you haven't spent by the end of the 8-week period at this time will be not forgiven and will, be a loan, but they are looking at extending that 8-week period to 16 or 24 weeks with this upcoming legislation. Okay, next question. Kind of the same thing with can payroll expenses for periods prior to the loan funding date that were not yet paid be used in the forgiveness calculation? Yes, even if they were incurred before, as long as they were paid after you received the funds and started your covered period, you can include those. Let's see, next question. If you had a salaried employee work less than 40 hours, say 37 in any given week, can you still count them as a full 1 FTE if their pay was not reduced? And I believe the answer to that is yes for somebody with 37, but technically no. You would still have to prorate them, but I believe you round up to the nearest 0.1, so a 37 would round up to a 1, somebody with 37 hours. But if they were down to 32 even, they wouldn't quite get up to that 1 FTE. And I know we had a lot of questions about that. If you have employees that are considered, you know, full-time employees at 32 hours a week, and that's how they get their benefits. You know, as far as the guidance states, I mean, it's pretty specific with the 40 hours, and I think we would probably want to rely on that. However, if they were working 32 hours, always their FTE levels would remain the same from the reference period to what you were having them in the covered period if you didn't reduce their hours. So I had a question, if the employees are international and live outside the US, is it possible to discharge those as well? And no, if the employees are international, their wages are specifically excluded from eligible payroll costs. There is one question here about if you elect the alternative covered period, when do you have to make that election? And that is when you file the forgiveness application. And we would recommend calculating it based on both to kind of see where you can maximize your covered payroll costs. If it would change, you know, just to calculate it both ways. Covered how the FTEs are for seasonal businesses. Obviously, you can use an alternative one. If an employer has reduced pay to 75% of regular salaries, but people can make up with it with 25% paid leave, can they be counted as 1 FTE? And I think this is kind of two separate things. So that you have to look at the wages and the FTEs separately. The wages, obviously, if they're being paid 75% and they choose with PTO or paid leave to make them back up to the 25%, I don't think there would be any wage reduction there. And honestly, there wouldn't be anyways, because you would have to dip below the 75% of their regular salaries to have any reduction for that as well. And then the FTEs, if they're using paid time off hours to make up for that time, those hours are eligible to be included in the calculation for the FTEs. Is the FTE affected by employees forced to work from home to provide childcare during the shutdown, or can those still be counted as full-time? If you are choosing to pay them full hours and they are working, then I don't believe there would be a wage or FTE reduction. Hourly, that might get a little bit tricky, but for salaried, it should remain the same.
On that point, Megan, if I understood the question correctly, if someone is working from home and they're reporting fewer hours than 40 or more, then that particular employee for that particular week or weeks within the covered period, their FTE status would be reduced. I mean, you've got to look at the reality that, you know, if they're working fewer than 40 hours, they're not working 1.0 FTE.
Yes, but they can make up for that with PTO if they so choose.
Oh yeah, if they report other types of hours that are available, sick, PTO or others, but where ultimately their paycheck is going to show 40 hours, and especially for those that are salary and don't see a reduction, then yes, that'll still come through as 1. But one of the things we have to remember is documentation of these kinds of hours and employees, and you need to have something that will verify how that person maintained a 1.0 FTE status when they were reporting during some of these covered weeks, 30 hours and 25, and we're only getting paid for those hours.
I had several questions related to different aspects of health insurance. So can dental and vision insurance premiums paid be included? The answer to that is yes. We had several questions also based on workers' compensation, and that is not as clear, although since those are somewhat related to medical insurance coverage, we believe you could make the stance that those would be included. Questions regarding lease payments for equipment, yes, those qualify as personal property lease payments in addition to things like vehicles and whatnot. I had a question regarding state and local income tax payments. Does that include Montana income tax? And that is already included in the employee's gross wage amount. And so no, those are not separately counted. Really, the state and local tax paid is really just the state unemployment, at least in Montana. Okay, and at that time, that kind of covers all the ones that I had taken from the chat and had answers for. I can even tell since I stopped taking things off of the chat, there's probably been 30 more questions in there. And so our team will take the time additionally, right, you know, in the next few days and answer those and come out with a question and answer PDF that we'll be sending out to all of the attendees today. So thanks, Jim. I'll turn it back over to you. I think you're on mute, Jim.
Sorry. Thank you, Megan. Great job in providing some good questions and answers. And then finally, as Stephanie mentioned at the outset, if you are interested in getting a copy of the slide deck for today's presentation, reach out to your contact at AZ and feel free to do so, and we'll get you those slides. But again, thank you for your attendance today. This is so exciting because it is, in all due respect, it's almost too good to be true that we're getting the benefit of this program. And yes, everybody deserves it. So have a great day.